Welcome to Bar Chart series of educational webinars designed to enlighten you about a variety of trading ideas and concepts, inform you of the tools and features Bar Chart provides related to these concepts, and offer you some traders' insight to help you make a more informed trading decision. Today's subject, understanding moving averages. Now, charts are the working tools of technical analysts, and moving averages provide technicians insight through visualization. Modern technical analysis tools like Ichimoku Cloud, Bollinger Bands, and moving average convergence and divergence all get their visualization DNA from moving averages. However, moving averages are far from these complexities tools, and at their core, they smooth out price data. They help to identify trends. They generate trading signals and offer levels of support and resistance. Do I dare say, without moving averages, today's technical analysis would be blind to the principles of trends, momentum, and price extremes? Hello, everyone. My name is John Rowland, Bar Chart's head of trading education, and today is part one of our two-part series to better understanding moving averages, their importance in technical analysis, their role in trend identification, and advanced strategies. Now, part one today, we're going to focus on the basic ideas and principles and the different types of moving averages. As well as I'm going to give you some considerations for choosing moving averages, along with highlighting some of the many moving average features found throughout the bar chart website. So stick around as we journey through the world of moving averages and tour the numerous tools that make up bar chart, the site. Now, before we get to all of that, please welcome our moderator and bar charts project director, Gene Baker. Hello, Gene.
Hi there, John. How are you?
I am doing well, and yourself?
Good. Good here on a nice Wednesday afternoon here in Chicago. Looking forward to the springtime coming out and yeah, getting ready for summer.
I noticed that next week the weather's going to change for the better, and we're going to see places like, for instance, in your area, you might see the 80s next week. So that's pretty exciting, right?
It is, yeah.
All right, Gene, you ready to get started then?
Sure. Let's get going.
Okay. Just a reminder, today is for educational purposes only, and decisions to buy, sell, or hold or trade securities, commodities, or any other investment involves risk and is best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any losses or damage you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on any information or material you receive through barchart.com and our services. Okay, so let's start with some basic principles associated with moving averages. First of all, it's one of the oldest and reliable technical analysis. And in my case, as a young apprentice, it was one of the first technical analysis tools that I learned. Now, moving averages are among the most advantageous methods of identifying and profiting from trend. Now, isn't that the reason why we trade or invest? Because we want to make money. And then moving averages are smooth visual representations of price action. They dampen the effects of short-term price variation and volatility. Now, moving averages are effective in markets that have a tendency to trend. In an upsloping moving average, the underlying asset tends to stay above the moving average. Now, this is the main actionable principle of moving averages. Very similar to the principle of physics that says that objects that are in motion have a tendency to stay in motion. Trending markets respect their moving averages. And finally, moving averages can be customized to fit the trader's needs. They can help them clarify the behaviors of price over a set of data or a specific look back period. Now, what they're not is a catch all tool, and one moving average alone is not a purposeful tool without some type of complementary analysis, like other moving averages or a change in time frame or other types of technical analysis. Still, moving averages provide many benefits to investors and trader, and the one is trend identifications. Now, trends are relative to the time frame that you are looking at them or that look back period, but discovery of trends as soon as possible maximizes profits. Longer periods are a better indication of price direction, but longer periods also have longer lag times, and this implies larger risk to trend changes. So here's the meta, and I have two moving averages here. I have the 200-day moving average, which is in black, and the 50-day moving average, both of them simple, in the blue. So the concept here is that first, it's a trend identification, and then the second is that longer periods of times or lookbacks tend to have a lag aspect to them. But you can see here, for instance, on the 50-day, right, this is where our 50-day moving average changed from negative to positive, from down sloping to up sloping. But that came after a bit of already price action. Our 200-day moving average didn't turn until way up here. In other words, that lag effect of a lot of data before the 200-day moving average turned. The other aspect is that, again, moving averages that are trending upsloping in this case respect the moving average. A trending upsloping moving average, price tends to stay above that moving average. When price is not trending, then it does not respect that moving average. And then when it starts to trend again, it does respect. And then the final aspect is that because of that lag time on these longer period moving averages, that there's a greater implied risk. And what do I mean by that? Well, if price were to come down and start influencing our 200-day moving average, in other words, changing from upsloping to downsloping, well, that would involve a large price movement in meta. In this case, it would look to me about a 30% price reduction. So that is a greater implied risk based on this longer term moving average. So support and resistance levels, moving averages can act as proxies for trend lines and often acts as levels of support and resistance. Also, it can be used as a risk management tool, alerting of us a possible change in trend, giving the trader permission to liquidate or reduce their position. So here's Apple, and what I did was I kind of just drew a couple trend lines here, and you can see one here, and one there. And again, trend lines are great to kind of give us an idea of where price is moving, and also can offer us, that idea of support or resistance. But notice here I have on the red line is a 20-day simple moving average, and that how the market again respects that moving average, and that when price engaged that moving average, it acted as a level of support as that trend continued. But a trend line break, when price breaks our trend line, could at least be a warning, but a change in direction of our moving average is a confirmation of a change in trend, right? Trend is your friend until the bend at the end. And again, notice how market respects our trend line and our moving average. Signal generating. So one of the simplest trend following systems is a moving average crossover. Now you do this when you are going to compare a fast moving average of a shorter period to a base or longer period moving average. Now the longer period moving average is typically a time frame that is in concert with the length of time a trader believes the trend will continue or that the trend's duration will be. And the shorter moving average alerts of changes to come. The crossover of the shorter from the larger generates the signal that of that change. And price action above or below both moving averages confirms the new trend. So let me go back to, well, let's do this. We'll just go here. So here's the cues, and inside of any of your charts up here on the right hand corner, there's something that says templates. Now you can create your own template, but bar chart does offer you some default templates. And a lot of these templates, as if you go in and investigate, are based on different types of moving average strategies. And the one that I want to emphasize right now is something called the golden cross or the death cross. And that is when the 50-day moving average crosses the 200-day moving average. When it crosses from below above, that is a signal, a buy signal. When it crosses from above below, then that is a sell signal. Excuse me. So when we look at here, in this example here, we can see that our 50-day moving average is starting to slope upwards, telling us there is a change afoot. And when it crosses over the 200-day, that generates that signal. And then when price is above both the 50 and in this case, the 200-day, then that would confirm a new trend. Now, this is one of the simplest trend following systems. As long as the 50 continues to stay above the 200, then we'll stay with the trend and stay with the trade. But again, we talked about this delay. If the 50 were to turn and then cross back over the 200, again, that might be a large amount of risk until that event happens. And determining price extremes. Now, moving averages are just a statistical means. And so when price extremes deviate from the mean, a revision to the mean presents a trading opportunity. So deviation from a moving average is just a measure of how far price has fallen or risen ahead of the trend's tendency. Now, as price starts to revert back towards the mean, this presents a trading opportunity. Now, the basis for many modern technical analysis indicators and oscillators, for instance, RSI, stochastics, MACDs, and Bollinger Bands are designed to identify these potential mean reversions. So here's Taiwan Semiconductor, and let's see, let me just kind of start here first. Let me turn this off for a second. So I've gone into templates again, bar chart templates, and we have one that's called MACD and RSI, and that is what I've uploaded here for Taiwan Semiconductor. And if you're familiar with these two technical analysis, they talk about being in overboughts or that crossovers on the MACDs can give you buy and sell signals. So what I did was I went into studies and I just added Bollinger Bands. And that's what I've done up here. And I've just turned it off for the visualization. There's a little eye here. I'm going to turn that back on. And so what we see here is that in price action, when price gets far away from its mean, that is a deviation. And that when price reverts or returns towards the mean, this can give us a potential trade opportunity. So we can see here is that we've got a deviation based on a Bollinger Band. We have an overbought condition based on RSI, and we see our momentum in our MACD is changing. All of these indicating a potential mean reversion. Now look at this in another aspect. When we look at Bollinger Bands, it's using a 20 period moving average. RSI is using a 14 period moving average, and MACD uses 12, 26, and 9. Different lengths of moving averages that come together that give us these more reliable trade signals. So there are many types of moving averages. And if we go into Learn under there where it says technical indicators, this is a library of all the technical indicators that we have. You can see that we have a lot of different types of moving averages that you can employ. But we're going to concentrate on just 3 today. We're just going to keep it simple, so to speak. We have a simple moving average. We're going to look at weighted moving averages, and we're going to look at exponential. Now, on our next webinar, part 2 next week, we'll look at some of these other types. For instance, high lows, channels, and bands, and some of these other ones that are here. So the first one is our simple moving average. And a simple moving average, which just adds a data set, price over a certain period of time, and divides the total by the number of observations or the number of periods in that data set. Now, these simple moving averages are the most commonly used and are sometimes referred to as arithmetic moving averages. Now, bar chart designates a simple moving average as MA, and we'll look at the other two in a moment. So if we think about equities, and we're thinking of it at the daily level, in other words, I'm looking at a daily chart. Some more popular moving averages are the 200-day, the 100, the 60, the 50, the 20, and the 10. Now, when I first started as an apprentice, as I said before, one of the first moving averages I was taught to calculate was the 10-day moving average, because it was like the easiest, right? All you had to do is add up 10 days of price action, and then you just move the decimal over one spot, and that would give you your moving average. I know that sounds crazy in terms of simplicity, but that's exactly what I was in charge of doing. Now, simple moving averages have the greatest lag time of the 3, but they do also identify trends after they have developed. We looked at that example in the 50 and the 200-day. So their signals are also delayed, but they are visually smoother than the weighted and exponential, and give us a greater confidence in trend identification. A lagging effect, but greater confidence. A weighted moving average it assigns different weights to different data points with a specific meaning of weights that decreases in a linear value over from the most recent to the last. So again, if you go into our education technical indicators, here's weighted. And under there, you can see this is a kind of a little chart that shows you how that weighting occurs, that linear progression from the most recent to the last. Now, weighted moving averages have a tendency to appear a lot closer to current price, and they're more responsive to recent price and trend changes than our simple. And exponentials. So exponentials apply a weighting factor as well, but it decreases on an exponential basis. And each observation by a factor or a percentage. Now, the oldest data in an exponential moving average is never really removed, but they only have a minimal impact on moving average. So what are we talking about here? So how old data is phased out in moving averages sometimes is referred to as the drop-off effect. So the earliest data is problematic for some of the other two moving averages, especially if that earlier data reflects a dramatic move or volatility. The moving average can be influenced by the removal of that older data. Now, this is one of the main criticisms of a simple moving average, the drop-off effect. So large changes can affect potential signals or maybe create false signals. So the EMA or exponential moving average eliminates the drop-off effect. Now, EMAs are most responsive to recent price changes among the three types we just mentioned here. They adapt and alert more quickly to changing market conditions, but that increased sensitivity may result in more false signals, especially during choppy markets, and they are also prone to whipsaws and increased price volatility. But they are favored by short-term traders and may be beneficial when the most recent price has a more bearing on future price direction and trend analysis. And many of our advanced technical analysis tools or systems employ EMAs. Now, I said there are other types of moving averages, and again, we will look at some of those in part 2 next week. So as for which is the right choice, well, that depends on several factors. And the one factor is, identifying a time frame that is right, or in the preference or the trading style, or even the market conditions being analyzed by the trader. Now, simple moving averages are straightforward and provide a much smoother trend analysis. And I would say that they are more adaptive to larger data sets or larger time frames, where weighted moving averages and exponential moving averages offer a quicker response to price changes, especially when we're examining shorter time periods, or whether our analysis needs to be sensitive to the current price conditions instead of, let's say, the whole data set. But again, that can increase the chances of potential false signals. So let's do this. Okay, so I'm going to go to Alcoa here. Not just again, I just picked this chart because I happen to know that it's been trending pretty well lately. And what I did here is I created a template on my own, which is called a simple weighted and EMA. And again, if you're not, how do you find those? You go into studies, And down in here, you could just type in moving averages, but there you can see where all those same moving averages are found. And in this one, you can see that we have black is our representative, our simple moving average designated by MA. Our purple is our weighted moving average, and our brown is our exponential. So when markets are trending, what you'll typically see is that the weighted, the purple, will be the closest to current price, as we see here. That our EMA will be next, and then that'll be followed by our simple moving average. Again, remember, simple has the greatest lag effect. But as conditions change, what you'll notice is that the EMA, the exponential, will start to become more sensitive to current price. And you can kind of see that today, right? We can see that our market has been in this nice uptrend, and we've had a little bit of a down day based on those economic numbers that came out today. And notice how our EMA has very sensitive to this current price action, and then actually kind of fallen in here, this case, below our lagging simple moving average. Our weighted is kind of moving too, but you can see that it looks like it's having a greater effect on our EMA than our WMA. Now, sometimes we can use this as these price crossovers as potential signals, and we talked about that just before. But what if we do is we layer upon these moving averages maybe a higher period moving average? For instance, let's add to our study. Again, I'm just going to write moving average, and I'm just going to add a simple 40 period, in this case, a 40-day moving average, and we're going to make that blue. Again, notice what our 40-day moving average is. It's been kind of flat for a long period of time, and now is just kind of starting to turn upwards. But we can use that as a potential buy signal as our shorter term moving averages crosses our longer term moving averages. But again, what I said to you is that what we might have to do, or as we start to choose different moving averages, we might want to start changing our time frames. So if I go to, let's say, a weekly time frame, again, um, do we get that buy signal that we see in our short term moving averages as we get that crossover? Yeah, we do. And it looks like it's around relatively around the same time. Now remember, this is a 40-week moving average, and these are 10-week moving averages. But they are all sloping upwards, which is a good sign that our trend is going to continue. Now I could also go the other way. I could drop down. So let's go down to a 60-minute time frame. Now I'm looking at 1 month of data in 60 minutes. So that means that these are 10 60-minute time frames and 40 time frames. Again, am I seeing an upsloping market based on these moving averages? That is in concert of what we saw in our weekly and our daily, but now at the intraday time frame, we're starting to see a bit of a change, right? We're starting to see that all of our shorter term moving averages have changed to probably upsloping to sideways, and maybe even looks like all of them are starting to turn downwards as we cross over that 40 period moving average. This could be a signal for us that we're seeing the dynamics of a potential change in our higher time frame moving averages. But right now, what the market is doing, as all positive moving, sloping moving averages, the market is respecting that moving average. So this might actually be an opportunity to re-engage or add or enter a position. So only time will tell in the next few days to see if we see that price breaks our higher time frame moving averages, and the lower signals a potential new downtrend. All right, so what are some other considerations that we can think about? Well, again, I just did that multiple time frame analysis for you. That is definitely a one way of uh, doing a uh, choosing different moving averages. But let's think about it like this. Let's say I'm a day trader, right? Or a short-term trader or a momentum. Maybe I'm just looking at momentum over a weekly basis. So is a 250-day moving average something that I would look at? Although I think it is important in the big picture, but it might not be the trend time frame that fits, my goals or in terms of risk. So maybe I might look at a lower or intraday time frame, or let's say a daily versus a weekly time frame. Now, if I'm an investment trader, then the 50 and 200-day moving average would be applicable to me, and I wouldn't be much concerned about intraday minutia. But let's think about a very specific time frames. For instance, if I chose that 10-day moving average, right, what does that represent? Well, 10 days represents 2 weeks of trading or a 2-week trend. And if I'm a 1-week momentum trader, in other words, I'm looking to put positions on Monday and exit them on Friday, then that 2-week trend would be applicable for me, because what I'm trying to do is I'm attempting to capture a piece of that trend or that momentum. But again, as I showed you, relying on just one time frame narrows your field of vision for trend development. So you always need to be conscious of the next longer or shorter time frame. Again, if I'm in a daily time frame, I want to be conscious of a intraday time frame and also of a weekly time frame, because they might be influencing my trend. And that example in Alcoa, both our daily and weeklies were trending up, but our lower time frame is showing us a change in momentum. So that might be starting to influence those higher time frames. But as a general rule, higher time frames always have a greater impact or influence on lower time frames. But in that rare occasion when all three line up together, that only gives us greater confidence in our analysis. So we also want to identify trends as soon as possible. The sooner we identify a trend, the greater the profit potential. So there are two variables that you can do here. First is you can look at short periods. Again, think about that 50 versus that 200 in the same time frame, a daily time frame. Or we can lower our time frame and use the same periods. I could look at, let's say, in the example I showed you, moving from a 10-day moving average to a 10 60-minute period, the same period, a different time frame. Again, here is that 10-day moving average on a 6-month time frame, right? And then I'm going down to a lower time frame using the same period. Or what I could do is go to go back to this and then change this time frame to maybe, let's say, a 3 EMA and see if I see any data change. So again, let me say that again. Two ways to do that, or to choosing moving averages: a short periods inside of the same time frame, a shorter period that may be less than your base time frame, or looking at a lower time frame of the same period. So we talked about this difference between fast and slow. I think this is a really important process in terms of choosing moving averages. And then there's something we can start thinking about in terms of individual asset classes or equities, or in even in our, you know, uh, our very individual stocks or ETFs, is the number of signals and then that performance of those different trends. So in bar chart, one of the cool features that we have, if I go into where it says trading strategies, and here you can see we have a lot of those different types of moving averages, those common ones, 20-day moving, 50-day, 100, 200-day, and also some very common crossovers as well. So what is nice about this is really a way how you can hone in on how you want to choose what types of moving averages you want to use. For instance, if you're a short-term trader or if you're a long-term trader. So let's just look at this, for instance. Here we see the 20-day moving average. How many trades has it initiated? Now, this is over a 5-year period. But also you can see here, it tells us that on average, the 20-day moving average signal usually lasts about 12 days. So is that in a time frame that I want to try to trade? Is that a time frame where I'm going to look for momentum type trades? That's my baseline. So what I would do is then I might look for a smaller time frame uh, moving average or period moving average, let's say a 3-period moving average, because I want to identify that trend as quickly as possible, because the trend here you can see on a 20-day moving average only lasts about 12 days on average. Now, I wouldn't worry so much about total profit, but that is definitely part of our process. But if I click on the moving average itself, what this will now give me is that analysis, performance analysis, where I can really kind of break this down. And I can look at, how much the profit was for each one of these. And again, what you're going to notice is the longer you're in the trade, usually the more profit you make. And how quickly, you get these turnarounds. What was our max profit? What was our drawdowns? And these are all part of system design analysis. But you can also look at just buys or sells, and what you might discover is, and again, remember the stock market is always a bullish bias, but you might discover that in some of your markets, especially if you're looking at a higher time frame, you might see a bias that maybe a buy is not the best for this particular candidate, or maybe the sells are the better. But again, that might be based on that higher time frame bias, that weekly or monthly time frame bias. So again, think about duration, number of signals, and does that fit your style? Another consideration we can think about is seasonal cycles. So think about, for instance, earnings season, right? Earnings season happen on a quarterly basis, and there's about 13 weeks in a quarter in the calendar year. So in 13 weeks, how many trading days are there? Well, there's 5 trading days a week, so about 60 to 65 trading days in one quarter. So if I'm trying to catch a trend from one earnings season to the next earnings season, that's 60, 65 days, or that 13 weeks, then I need to find a moving average that would be less than that to allow me to catch the part of that longer duration. So maybe I might look at a 10-day moving average, or maybe a 3 week or a 4 week um, uh, moving average. And so when we do this analysis of number of singles, the performance, and these cycles that I'm going to be looking at in terms of frequency of trade or length of the trades, one of the very simple rules that we can use is called the quarter rule. And the quarter rule is applicable to both moving averages and also to time frames. So for instance, in this example, we're looking at a 20-day moving average as our base. That's the trend that we're trying to capture. And then we'll use a 5-day moving average as our signal. But if I think about time frames, right, I could be talking about a weekly versus a daily, right? There's a weekly, 4 weeks in a month, and then there's 5 trading days in a week. So I could use the quarter rule as a time frame analysis as well. Think about our 50 and 200, our golden cross. That is a quarter rule. Now, the other thing we can do when we do time frame analysis, so let me go back to Alcoa, and I'm going to put up the chart again. And under templates here, I have a template of my own, which is I use is called the 13, 26, and 52 EMA. Now, if I put that up, you will see that it brings me into a weekly chart. Well, what does 13, 26, and 52 represent at a weekly level? Well, right, 13 weeks is 1 quarter, 26 weeks is a half a year, and 52 weeks is a whole year. Again, this gives me that kind of that big picture, very trend identifying analysis. But also I can use this template now if I want it to do that smaller time frame analysis. I'm using the same periods, but I'm going to go to a smaller time frame. What if I jump all the way down, let's say, to a 30-minute time frame? Now, what does that represent? Well, if you think about the equities market, it opens up at 9:30 in the morning and it closes at 4 o'clock. Well, there are 13 30-minute periods in one day in the equities market. So that means that a 13 EMA would give me kind of a 1-day moving average. A 26 EMA would give me a 2-day moving average, and a 52 EMA would give me a 4-day moving average. So what I could do now is I've used the same period, but I've changed the time frame. I just want to make sure that those time frames are applicable to the trading style that I wanted to execute trades in. And again, notice here that the similarities in terms of our exponential, our different time frames, and also how our trend, in this case, respects our moving averages, as long as the market is trending, and that when it doesn't trend in terms of sideways, that could be a change in potential change in momentum, but how price fluctuates around a moving average that is not trending. Okay. All right, so Gene, I think that's a lot of information to take here. Let's see if we can digest here for a moment. I want to see if I can answer a couple questions that are popping up. Whoops. And I think looks like, Gene, you've been answering a lot of the questions, so thank you very, very much.
Yeah, I've been busy here. So I do want to say that John was showing you trading strategies on the bar chart website. And in order to view those trading strategies and how many days these moving averages and different indicators have been in, that requires at least a Bar Chart Plus subscription. Now, Bar Chart Plus is priced at only $9.99 a month. It's extremely affordable, and it gives you a ton of information. So if you haven't tried Bar Chart Plus or Bar Chart Premier, in order to unlock this valuable information, we do offer a free 30-day trial. That's my thing to add in here.
Okay, Gene, great. I think looks like you answered a lot of the questions. So folks, if you have any questions, this would be a great time to send them in. All right, so let's do this. Let's move forward until we get any more. And so bar chart offers, and again, this is kind of something what Gene has just expressed to us, offers a lot of different trend identifying features. So I want to kind of just show you a few of them. I want to highlight them. And again, in next week's webinar, we'll feature a couple of these and we'll really go deep inside them. So the first one is market momentum and performance. So let me show you where that is. So if I go under stocks and underneath stock here, market pulse, there's market momentum and market performance. So first of all, on market momentum, there are a couple of nice little features. This is kind of your internal breadth. But what I'm going to show you down here is it looks at the market overall, and you can see how many stocks are above their 20-day moving average, their 50-day moving average, the 100-day, 150, and 200-day moving average. Again, remember we were talking about developing a strategy or looking at a particular stock that has a tendency to perform better in downtrends or performs better in uptrends. So if I'm looking at, let's say, the 20-day moving average and only 30% of today's stocks are above their 20-day moving average, and I'm employing a bullish strategy, I better make sure that that stock has a very strong tendency, bullish tendency, because the weight of the market really is telling me that there's really more like almost 70% of the stocks are down below the 20-day moving average. Performance-wise, again, a very cool feature is here we can see that this is a little bit more granular, 5-day, 20-day, 50, 100, 150, 200 days. And not only is it granular in that aspect, but also by indexes and sectors. So again, for instance, on the 20-day moving average for today, the S&P, only 28% of stocks in the S&P 500 are above the 20-day moving average. That might be a bearish signal for us. So why can't I use this data set again and the power of moving averages? So what I've done here is I've added a 5 EMA, a 5-period or a 5-day moving average to that percentage of where the stocks are above or below the 20-day moving average. And what is my trend? Well, I see a sideways to looks like we're starting to trend lower in terms of number of stocks that are below the 20-day moving average. Again, would I be inclined to looking for bullish opportunities in this type of trending market? Maybe, but most likely, maybe not. Maybe I would be waiting for when I see this trend start to change, that performance trend of the broader market. Underneath investing, we have something called bullish moving averages. And this one is a nice feature because what it does is it looks at both stocks and ETFs, and it gives you that 20, 50, and 100-day moving average. Now, what we can do here is very quickly look at this and say, all right, let's look at this from right to left. Here's my 100-day moving average, it's 23. Here's my 50-day moving average, 36. And here's my 20-day moving average, 61. So each of the preceding moving averages of shorter time frame is above. So visualizing that, right, that visualization, we know that this is an uptrending market and that our lower time frame is the strongest of the 3 moving averages. Now look here at Carvana though. Notice how we do see some different colors here, red and green. So if I see a red number here based on my 20-day moving average, what it's telling me is that current price is below my 2 in this case, 20-day moving average. Again, that might be a signal to me of a change of a momentum. So let's take that one step further. So I can go into the plus sign here, and this is where I can get more data. I'm going to look at something called opinion. Now, you can find the opinion page on any equity based on from the beginning of the, I'll show you in a second, the price overview. You can find this little box, but let's go to the full opinion. And what this does is it looks at all those different moving averages and those crossovers, and it tells you if the common interpretation for those moving averages is a buy or sell signal. In other words, is it above? Is price above or is it below, or we have that positive crossover or that negative crossover? And you can see here for Carvana, the 20-day moving average is a sell. Well, why is it a sell? Because current price is below the 20-day moving average. But we can see all the other ones are still in buy. And what we can also do is then look at something called strength and direction. And these are kind of ways to look at the momentum of our different moving averages. And there are several webinars in our archives that goes into a lot more descriptive analysis of how you can use bar charts opinion and bar charts strength and direction. So bear with me for a moment. I'll show you where that is. I did want to show you from the price overview box or tab, you can see where you can find bar charts, technical opinion, and that'll take you to that data page. All right, so for my futures traders, we have something called the futures trading guide, and this is a moving average, hypothetical moving average system that uses the 9-day and the 18-day moving average. And again, it breaks this down in terms about the entry point, the duration, and the potential profit of, or excuse me, the current profit, or as the trade is closed out, you can get the details of, and again, I think, Gene, you can help me out on this one. I believe this is a premier feature. Is that correct? I'm sorry to do that to you, Gene.
Yeah, I'm sorry, I was on mute there. The charting that you're showing, no, that's if you need a Bar Chart Plus subscription, you'll be able to view those charts.
Excellent, excellent. Okay. So Jimmy writes in that he uses the 20, 50, 100, and 200-day simple DMA different than your presentation. I don't know, Jim, is that what I used? Let's see, let me just double check. Here's our templates. Here's our 20, 50, 100-day, and they all are simple moving averages. Okay.
And you know what, John? I'm gonna correct myself. You are showing the futures trading guide, and yes, the futures trading guide is accessible with a Bar Chart Premier membership. So again, if you want to try out Premier, we give you a free 30-day trial on that.
Excellent. Thank you, Gene. I do see a question. Jerry says that all of this looks great, but his concerns it can be overwhelming. Again, Jerry, I wanted to kind of just give you a wide range of all the different tools we have. But I think if you start doing analysis, think about what you want to accomplish, what time frame, a style of trader that you're going to be, then you'll see the pieces will fall very easily into place. Simple being more of your visualization, more of a lagging, but a greater confidence of a trend, where in exponentials will be more sensitive to current prices, and those might be your signal indicators, right? And then that four factor, thinking about finding a base level of moving average that you want to trade, and then looking at a moving average that is 4 times less than your base, and that will also help you generate some of those trading signals. Okay. So I talked about the investment page, bar chart strength and direction, and our futures trading guide. And so, Jerry, here's where I'll help you out. So you want to be start out at the basics. You want to be a little bit more static in your analysis. So for my investors in the room, here's a webinar in our archives on the Golden Cross. For my futures traders, a little bit more dynamic, a little bit more faster moving markets, how we can use our futures trading guide to find better trades. And then somewhere in between those two, this ideal of trend trading and momentum is found in this webinar, where we break down that ideal of strength and direction, that bar chart opinion page. And this is where you can get that ideas about which of the different types of moving average or moving average crossovers that fits your style, and then how to read the tea leaves, or in what I talk about, how to read the instrument panel of your engine, your trend, to tell you if your engine is revving and moving in the right direction, or if it's stalling or changing momentum.
And one thing I want to point out for the people at home listening in, so the slides that John is presenting, and I'm talking specifically about these 3 webinars, they are available for you to download. And if you go to that slide with those 3 different webinars, the PDF is clickable, so it will take you directly to those different archived webinars. Otherwise, you can go into, John was just on the, he's showing you how to download the slides. But if you go back to the archive, you can also search for the titles on that in the archive. But the PDF is very helpful because it will take you directly there.
Nope, that's not how you spell it. Right? Right? No, man, I'm a horrible speller. Yeah.
Yeah, that's not going to find it. Anyway,
but
they're there. If you type in the search term,
just type in one of the keywords in the titles, and you'll find it, right? So, for instance, golden, that should work. There we go. Understanding Golden Cross. Okay. All right. And so next week, again, this was part 1 of our series. Next week, we're going to dive into some of those systems, some of those features that we have on our page. We're going to also add that element of risk management. And so that is profiting from moving averages and some of these advanced strategies. So again, maybe a little homework, hint, 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 watch that Golden Cross, watch that strength and direction, because I guarantee you we will be talking about those two. The other one that we have is called the moving average convergence divergence, or the MACD, and we'll probably be doing a little bit of investigation in that one as well. All right, Gene, that's it. Thanks so much for helping me. If I didn't get to your questions, please send them to support@barchart.com. And if our crack staff can't answer them, they'll pass them along to me. I appreciate the comments here. Thanks so much. So folks, until next time, next week, be safe out there, manage your risk, and the good of all trading.